Howdy, Jacob here. Today we're going to do an in-depth analysis on LYFT. I have not currently done an initial analysis, but um, in the background, I do have some companies that I look at, and based on my initial analysis that I haven't posted, it looked like an interesting stock and company to invest in right now. And so I did want to, even though I haven't done an initial analysis, this is just going to be the same as all my in-depth reviews where I reviewed the company's 10K, most recent quarterly reports, an annual report, pulled out some information that I think is important, and then instead of redo an analysis, paste in Excel my uh, post-analysis projections. And so everyone knows Lyft, I presume. They're kind of in the biopoly, I would say, with Uber. They own over 98% of the market share of what is it, peer-to-peer transportation. That'll be one of my notes, so I'll be more specific there. But I do just want to quickly review the financials, and then we'll get into some of the uh, items I took from the most recent quarterly reports in 10K. And so, first thing I notice is a very attractive enterprise value in comparison to their market cap. 4.6 billion market cap, 3.2 billion enterprise value in the ground transportation industry. They offer a peer-to-peer marketplace for on-demand ride sharing in the United States and Canada. So they're just in United States and Canada. They were formerly known as Zimride and changed its name to Lyft in April of 2013, headquartered in San Fran, California. So huge revenue. Obviously, on a year-over-year basis, it has gone down from the immense 208% in 2017 down to as little as 7.5% in 2023, big hit from COVID, but they are still growing fairly significantly with an increased gross margin and operating margin over the last 10 years. They're still trying to find that positive margin. And we can see from their income statement, they do have some expense of R&D. Interesting that it has gone down quite significantly from 2019, but their growth is still high, and they're still investing 5 to 10% for R&D. So not terribly concerned with that. I would prefer that to be higher, but the fact they're recently making money, they're still growing. I'm just concerned that it'll slow their growth, which you'll see in my projection. Balance sheet shows just about $2 billion in cash and short-term investments, with 429 million short-term investments, 566 million long-term investments. So enough cash to pay off that debt or cash-like products. So not concerned with that. And just recently produced positive free cash flow. A lot of investments. Outside that, just a little bit of debt reduction. More recently, share purchases. So let's look at some of the things I took from the 10K most recent quarterly reports and get into where I'm thinking, the decent prices. And so announced in 24 Q4, a share repurchase program of $500 million, which currently represents a little over 10% of their market cap. And so this is coming out Monday. We can still see that it is just over 10%, because I have to say that with how volatile this market's been. But anyways, representing a little over 10% of the market cap. Pretty positive news. Hopefully that means they think that their stock is cheap at this price, and so that's why they're buying it. And the fact that they've recently produced positive free cash flow, if they're able to keep that up, not a concern that they're using capital allocation to buy back shares that are hopefully cheap, which, subjective on your analysis and my analysis, perspective based, but I guess we'll see when we get to the price point. So in 25 Q1, the outlook of gross bookings is 10 to 14% year over year. Rides growth mid-teens year over year. Their co-founders, John Zimmer and Logan Green, stepped down from a full-time executive role in 2023, but they still hold the chair and vice chair on the Lyft board. The new CEO is a seasoned tech executive who previously worked as Amazon's first head of product and head of U.S. retail, as well as was a general manager at Microsoft. And so Amazon, has, I'm sure everyone I don't know how you could possibly live on this earth and not have heard of them, at least live in the United States and not heard of them. So he was the 37th employee at Amazon, who currently has over $1.5 million and got to as high as, I think, over 1.6 million post COVID with all the demand. So for him to be that seasoned of an Amazon employee who really grew it from maybe a couple mil to multi-billion dollar, tens and hundreds of billion, very impressive. He became CEO in 2023, but even 2 years prior was on the board of LYFT. So he knows about the business. He was on the board before he became CEO. Co-founders hold over 29% of voting power. Not a bad thing, just enough to say that they do have some power in decision making. But also that means that they're heavily invested in the business. They do own shares of stock that have more voting power than classic A shares, but even still, they are heavily invested in the business, so they're going to likely do what's best for it. And they started it. So, I mean, for co-founders to still be in the business and still be on the board is a very awesome thing in my eyes. They have a short history, big negative here. So with the ride-sharing marketplace launched in 2012 and a short history of profitability the last year, we're not looking at a lot of history. So I would require a larger margin of safety than the average business, like a Coca-Cola that's so consistent, or a Pepsi, or a man, I don't know why my brain, Procter and Gamble, Johnson and Johnson, one of those huge histories, almost centuries of history to look at of consistent profitability and free cash flow margin. Here we're seeing 1 year. So are they able to keep that going? Are they going to spend a crap ton in R&D and go back to losing money, but hopefully growing a lot? I mean, it's a big balance here. There's a lot of unknowns from a present value free cash flow and earnings perspective. Their ride-sharing market is about 74% Uber, 24% Lyft, according to Bloomberg. So again, this is where I said they have about 98% of the ride-sharing market. I don't think I've heard of another ride-sharing company, only Uber and Lyft. And personally, I've actually just recently switched to Lyft because I'll still look at all of them, but it's essentially $5 cheaper every single time I look. And so I just picked the cheaper option. I think that's pretty common with a lot of people. I think that, they're going to stick with what they know. So if they're stuck with Uber, they don't have Lyft. But I do know a lot of people personally that have both. They'll check both and they'll just pick the cheaper option. But for me personally, recently, Lyft has been consistently cheaper. Lyft is only offered in US and Canada currently, whereas Uber is a bit more widespread in the global aspect. R&D is nearly 7% of revenue in 2024, but down from 12% in 2023. And we saw that it was down pretty significantly from pre-COVID levels as well. This decrease was primarily due to a decrease in stock-based compensation and personal-related costs driven by a headcount reduction in 24 Q3. So they have 429 mil of debt due within the year, 466 mil of long-term debt due in 2029. Over the last 3 years, it's a little bit challenging to look at since they only produced positive free cash flow this year, but even averaging amount, about 50 mil went to share purchases in 2024, along with the remaining 166 million of free cash flow between debt reduction, marketable securities, investments. But again, it's just a short history. We don't have a long history of positive free cash flow to look at where capital allocation is being sent to. Revenue is generated from a multimodal transportation network, but 85% is from ride-sharing marketplace connecting drivers to riders. So what you would think of Lyft as the, picking you up from going downtown or picking you up from the airport, whatever, is about 85% of the revenue. The others is from scooters and other forms of revenue. Anyways, based on their revenue or their research and development expenses going down, I think that that's going to hinder their growth a bit. I do think that this market is still expanding very quickly, and I think that they could gain some share, especially if people start viewing them as a competitor to Uber and just look at the cheaper option. I think that that'll sprout demand pretty heavily. I'm going with a 10 to 15% margin. That's pretty consistent with Uber as well. Share change is very high if you look at their stock-based compensation. So I'm putting about 5% in. Again, they are doing they are doing share purchases, so that could help a little bit. 18 on the P, price free cash flow, 17.5% return. and we're saying it's 15% above. So this could be an interesting company. I hope you look at it, do a deeper dive, and I hope you have a great rest of your day.